Welcome to the Stock Market Palantir. Today we are going to talk about BCG. We're setting the stage for what was, one of the most remarkable and structurally complex trading events of the year. We are analyzing Bina Capital Group, Inc., NASDAQ ticker BCG. On November 13th and 14th, 2025, the stock just experienced this dramatic surge, gaining about 21.4%. But the number that really defines this whole event is the volume. 23.1 million shares traded in a single day.
Yeah.
And you have to consider, the company only has 16,602,460 shares outstanding. So the entire float, and then some, turned over almost instantly.
And that unprecedented volume anomaly is really where the debate is, right? It's where the intellectual friction in this whole analysis lies. How do you square that level of turnover with the underlying news?
Exactly. So the core question is this. Was this rapid price change and this explosive volume the result of a genuine fundamentals-driven reevaluation, or was the scale of turnover primarily a technically engineered market event, one that was exploiting the stock's low liquidity and its specific structural setup? My position is that the decisive Q3 2025 financial turnaround was the core catalyst. It forced a necessary, fundamentals-driven repricing that the market just couldn't ignore anymore.
Okay, I see why you emphasize the news, but I come at it from a different angle. I believe the sheer volume relative to the float, combined with the highly unusual trading patterns before the catalyst, it all points decisively toward a sophisticated, technical event driven by institutional positioning. The fundamental news was certainly positive, I'll give you that, but it acted only as the spark for an immediate, mechanically executed explosion that the market structure had already prepared. So fundamentals dictated the price target, but I think the technical structure dictated the speed and the scale of the movement.
Well, to establish the foundational basis for this move, we have to start with the facts of the turnaround. Before November 13th, Bina Capital was viewed skeptically, largely because it was a post-SPAC company. It was considered, a speculative, cash-burning entity, and you could see that in its trailing 12-month net income of negative $1.87 million. And the market reflected this risk, giving it a really low $23.66 million market cap. The Q3 2025 earnings report, it fundamentally de-risked the company. It delivered definitive proof of viability by showing GAAP net income of $2.1 million for the first 9 months of 2025. Revenue grew 10% to $137 million. And most tellingly, their adjusted EBITDA surged nearly six-fold to $5.8 million for that same 9-month period. So when the CEO explicitly confirms they are, and I'm quoting, delivering GAAP profitability, you are moving the company from a speculative, loss-making structure to a demonstrable profit generator. That kind of shift demands a massive market recalibration. And the 23.1 million share turnover, well, that proves the speed and the scale of that necessary adjustment.
That's a compelling argument for the necessity of a valuation change. But let me challenge the mechanism by which that change happened. The sheer scale of turnover, exceeding the entire outstanding share count, that cannot be attributed just to widespread enthusiasm. If this was a broad, fundamentals-driven event, we would expect to see a much clearer footprint. But the stock was almost entirely obscured by this widespread ticker confusion. In the public eye, particularly among the retail trading community that's often credited with generating this kind of explosive volatility, the BCG acronym means Boston Consulting Group, which is frankly infamous in certain forums, or it means Brightcom Group Limited, the actively traded Indian entity. Bina Capital had a negligible footprint in public sentiment channels. This ticker camouflage means the essential ingredient for an explosive, organic, retail-driven surge was just missing. So, therefore, we have to conclude this was not a consensus valuation adjustment, but an institutional momentum trade. And this forces us to analyze the setup through the lens of institutional execution, which brings us to the core contradiction in the pre-announcement data, dark pool activity. As of November 7th, total short interest was negligible, only 1.06%. So this tells us sophisticated players were not net bearish on BCG. However, in the weeks leading up to the announcement, we saw these bizarrely high daily off-exchange short volume ratios, 68.39% on October 27th, and 47.05% on November 3rd. So how can you have almost no bearish conviction overall, yet see half or even more of daily off-exchange trading tagged as a short sale?
Okay, that is the pivotal piece of evidence, and I acknowledge the apparent contradiction. However, I insist that this data actually supports the fundamentals thesis when we correctly interpret the intent behind the mechanics. Since the net short interest was minimal, the high gross short volume was not simple bearish positioning. It was instead the observable footprint of sophisticated institutions anonymously accumulating massive long positions in, anticipation of the positive earnings catalyst. Look, to build a position of that size, we're talking potentially millions of shares. In a tightly held, illiquid post-SPAC stock like this one, you just can't buy on the open exchange without immediately triggering the very price spike you're hoping to profit from. Institutions, they use complex, multi-leg strategies and dark pools that often involve simultaneously selling a short position as a hedge while the actual long block is executed. Or they use algorithms that temporarily mark transactions as short sales for technical compliance or tax purposes during a large accumulation program.
I see why you think that, and it's a plausible interpretation of the net outcome, but it still foregrounds the technical setup as the dominant force here. This isn't just about accumulation, it's about the mechanics of how that accumulation shows up on the tape. When high-frequency trading algorithms or institutions use these complex structures, often involving short tags, to build long positions, they are deliberately creating or exploiting the existing illiquidity. The high gross short volume meant that the supply on the public tape was being aggressively managed and absorbed off exchange. This positioning itself created the tinder. Right, so if the market structure allows a handful of sophisticated players to accumulate shares effectively hidden from the public tape, that accumulation creates an eventual supply shock. The positive news was merely the environmental factor, the wind, that turned that accumulated tinder into a firestorm. It facilitated the rapid turnover. The execution mechanism was ready for an explosion regardless of the precise level of the positive financial surprise.
But I have to reiterate the corporate history here, because it explains why the market was so sensitive to this particular news. Bina Capital's history as a post-SPAC entity merged in March 2024 is crucial. Post-SPAC companies frequently face a crisis of confidence. Their business models are often viewed as aspirational, not proven. Achieving GAAP profitability, that $2.1 million net income, provides the ultimate validation. It moved the stock from being priced for potential failure and dilution to being priced as a legitimate, scalable business consolidating independent broker-dealers. This is more than just good news. This is a systemic re-rating. That fundamental validation is the core value driver that justified not just a 21% gain, but the massive repositioning we saw in the volume. Smart money accumulated because they believed in the viability, and the volume explosion was the ultimate public market confirmation that they were right.
I agree that the fundamental validation is significant, but let's connect it back to the lack of public participation. If sophisticated accumulation positioned the stock ahead of time, and retail was absent due to the persistent ticker confusion, which, we saw spill over into internet queries, mixing up BCG with the Indian entity and asking about reverse splits, then the resulting movement wasn't driven by a market-wide consensus on value. It was an aggressive, institutionally facilitated momentum trade executed by the few who understood the setup and the actual ticker. The move wasn't a steady climb reflecting gradual price discovery. It was a sudden, amplified reaction executed because the structural setup allowed for maximum immediate repricing with limited drag from new sellers. The speed of the execution, it just speaks to a technical closure, not an organic uptake.
Then we fundamentally disagree on the primary force. For me, the volume explosion of 23.1 million shares was the unavoidable effect of the market, and especially sophisticated institutions realizing the company was profitable. And this was triggered decisively by the November 13 filings. The proof of profitability was the engine driving the train.
And for me, the specific accumulation strategies represented by those high dark pool short volume ratios leading up to November 13th were the essential cause of the technical setup. The pre-positioning was the mechanism that guaranteed an explosive, amplified reaction. The news simply provided the spark for the massive, technically facilitated turnover, which was already coiled and ready to spring. This is a crucial distinction when you're analyzing illiquid market reactions.
While market structure and the use of dark pools certainly played a definitive role in the execution of the move, amplifying the velocity, the primary driver remains the underlying fundamental inflection. Bina Capital Group proved its viability. It fundamentally shifted categories from a speculative entity to a value company priced for success. That underlying reality is what justified the entire event.
I conclude that the unique combination of factors here, the extremely high gross stock short volume, the unprecedented turnover rate exceeding total shares outstanding, and the total absence of clear retail sentiment due to the widespread BCG ticker confusion, it makes this a prime example of a fundamentally positive story whose market reaction was entirely dictated by sophisticated technical positioning. The event really illuminated the deep separation between fundamental value and market execution mechanisms in illiquid post-SPAC stocks.
So this BCG spike represents a fascinating duality. It was both a genuine financial turnaround that proved a skeptical SPAC model viable, and, at the same time, a technically complex market event whose mechanical execution was amplified and perhaps even hidden by widespread ticker confusion and sophisticated accumulation strategies.
A valuable lesson in recognizing that fundamental strength often requires a highly technical facilitation to translate into immediate and explosive market action, especially in these low-float names.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.